Hi, welcome to today's webinar on fair value, best practices, and implementation. I'm going to go over a few housekeeping items to get us started. All attendees are placed on mute, but you can type any questions you have into the question box on your dashboard. We will hold any questions submitted throughout the presentation to answer them at the end. Should we not have time to address all questions, we will follow up with you directly to ensure your questions are answered. A survey will appear on your screen following today's presentation. We value your feedback on how we can make these webinars as valuable to you as possible, so please fill it out if you have time. A recording of today's webinar and the slide deck will be emailed to all registrants following the webinar, so look out for that in your email over the next day or two. For those who are seeking CPE credits today, you must answer all 3 poll questions during the presentation. You do not need to answer correctly, but you must submit an answer. CPE certificates for those who qualify will be sent via email. Please look for those in the next few weeks. With that, we're going to get started. I'm going to hand it over to Monica Blocker, Vice President of Houlihan Capital, to introduce today's presenters.
Thank you, Gabrielle. As she mentioned, my name is Monica Blocker, and I'm a Vice President here at Houlihan Capital. Welcome, everyone. We are a valuation and boutique investment banking firm that specializes in providing alternative investment funds with independent valuations of their liquid assets. I just want to thank all of our clients and friends in the industry for joining us today for our webinar titled Fair Value Best Practices and Implementation. The reason why Houlihan Capital and Richey May decided to host this webinar is because when we talk with our respective clients, valuation is often one of the most common questions we receive. So we wanted to bring some value to the industry and make things a little easier for everyone to understand. We hope you find this webinar beneficial as our experts Paul and Christine share their industry knowledge. I will now hand it over to our first speaker, Paul Clark, who is our Head of Valuation at Houlihan Capital.
Thanks, Monica. Okay, there's the agenda. We're going to touch on all those topics, although I'm going to deviate slightly to begin with. I want to just, as a starting point, start with ASC 820 and its particulars. ASC 820 was originally issued in September 2006 as FAS 157. It defines fair value, it establishes a framework for measuring fair value, and identifies required disclosures. The definition is, as shown, it's the price that would be received to sell an asset or pay to transfer a liability in an orderly transaction between market participants as the measurement date. First concept there is it is an exit price concept. It's a price received to sell. It excludes transaction costs, typically, as these are not a characteristic of the asset liability itself. Fair value is a market-based measurement rather than an entity-specific measurement, meaning that in specific entities' holding period, required returns, specific synergies, ability to fulfill a liability, etc., are not relevant in establishing fair value. Fair value is a market-based measurement. Market-based measurement means rather than an entity-specific measurement. In addition to what I just mentioned, it assumes market participants are acting in the principal market or the most advantageous market. The principal market generally means the market with the highest volume and level of activity for such an asset. For financial assets, obviously, exchange-traded quotes are going to be the most principal market. If on the other side of the extreme, if you've got a vacant lot that can be used for a better purpose, then it wouldn't be valued under its current use. It would be valued in what would be assumed to be the principal market or the most advantageous market. Finally, ASC 820 establishes a hierarchy for fair value measurements between level 1 and level 3. Depending on their basically liquidity, and we will get into that later. Last thing I did want to mention about ASC 820 is it applies for most valuations for financial reporting purposes but it does not apply to share-based payments and valuations, such as stock compensation, options, grants, etc. So we often have clients ask us, hey, can I use your fair value estimate for those purposes? And the answer is typically no. There may be certain considerations that go into evaluation for stock compensation that are excluded from fair value measurements under ASC 820. Basically, the general concept of ASC 820 is that funds, companies are no longer able to carry their investments at cost or impaired value. They must be marked at fair value as independently assessed either by management itself or under the auspices of guidance from an independent appraiser. Last thing, and I know Christine will talk about it, is ASC 20 requires significant detailed disclosures regarding the fair value estimates and the inputs that are used to find them. I also thought we should talk about a couple of slides about valuation and fund management responsibility and valuation policies and procedures. It is ultimately the board's responsibility to mark investments at fair value. That responsibility can be delegated, often is, to someone within the fund or the investment advisor, and particularly usually to the investment advisor or a valuation committee, but ultimately is the fund's responsibility. Even if the investment advisor or the valuation committee does hire an independent valuation firm such as ours, it is still management's responsibility for the mark. It's just something to note and take consideration of. In fact, our engagement letters are specifically written that way to make sure that we communicate to our clients that it is ultimately your responsibility. One of the things that is very important for fund management on fair value issues is to establish valuation policies and procedures. There's no rule that requires it, but there's certainly SEC guidance that indicates advisors should implement policies and procedures. One of the things that we get asked quite frequently is, shouldn't the portfolio managers or the investment deal teams determine the valuations? Frankly, the PMs are closest to the market, but because of compensation and other issues, they may have conflicts of interest in valuing the marks. Therefore, the policies and procedures and board oversight should really be implemented to mitigate and resolve those types of conflicts. The Pricing Valuation Committee should be written and should address some difficult things. They should address the potential or actual conflicts of interest. The Valuation Committee, because of the reasons we just discussed, should be independent from pressure to obtain the highest valuation. The Valuation Committee, the board, should document the findings and the process that they go through. And most importantly, they should test the accuracy of the valuations, particularly upon an exit of an investment, which is something called back testing, which we'll talk about a little bit later. One of the things just to note is that your valuation policy and procedure is meant to be a living document. It is meant to be revisited at least annually and revised as appropriate as the types of investments change or more knowledge is gained about the valuation policies, process, and the markets in which the investments are made. One of the things that we often note and discuss with our clients is where you're going to run into risk and problems is either from your LPs and investors or from the SEC ultimately, isn't necessarily going to be challenging valuations as wrong per se, but they're going to be looking as to whether or not the policies and procedures were followed, whether or not the policies and procedures are accurate. They're going to be looking at whether or not your disclosures were improper and or other insufficient statements to your auditors. Okay. With that, I think it's time for our first poll question. And not knowing exactly who's on as an attendee, wanted to talk about or ask you how or when you plan to implement your fair value-based best practices, whether you have launched them already, if you're going to be launching a new fund in the coming months or year, whether or not you're going to be reviewing your existing fund valuation policies and procedures, a combination of the above, or just simply in educating your fund managers as a service provider. Okay, while we're dealing with these technicalities, I'll go on to the next slide. It really is pretty basic, and that is, why is valuation so important? Your fair value estimates, particularly for funds and those that charge as a percent of AUM, fair value drives your net assets. Therefore, it drives the fees that you charge. If fair value is understated or overstated, it has implications for those fees. It has implications for management fees. It has implications for prices at which your investors buy in and exchange out. It has implications for fundraising if you're marketing performance based on past fair value estimates. So a lot of potential issues there relating to fair value estimates. So stating the obvious, it's an important issue that funds and investment advisors should take into account. Okay, so now we'll get back to the agenda and talk about the fair value hierarchy. As most of you probably know, ASC 820 identifies 3 levels of inputs depending on the type of liquidity of the asset. Well, level 1 are the most liquid. These are going to be actively traded stocks, bonds, CLOs, MBS, et cetera, where a market quote and an actual trade can be identified and sourced. Level 2 is slightly different from that. They may be like securities that have similar assets that are trading but not directly tied to the particular assets that you're looking for. Level 2 assets would typically be probably corporate bonds and loans, less liquid and restricted equity securities, possibly certain over-the-counter derivatives where a price quote isn't exactly, a trade, isn't actively identified in the market. These types of level 2 assets can be identified where you might be getting broker quotes, but in an inactive market, there might be a wide spread between the bid and the ask. Those type of things where there's evidence of value but not direct exchanges traded market. And then level 3 is obviously the most illiquid, hardest to value assets. They are not traded typically at all. These are going to be your private equity investments, non-traded debt, the non-traded MBS, CLOs, things like that. The next couple pages get into a little bit more detail about the level 1, level 2, level 3 assets. I'll just leave them there for informational purposes. I'm not going to get into them directly. But we wanted to get into valuation techniques and methodologies. There's generally 3 approaches that are considered. One is the market approach, second, the income approach, cost approach. Market approach is where you're looking at market multiples, usually based on guideline public traded companies or comparable control transactions. For instance, if company A buys controlling interest in company B, we can look at the multiple paid as a multiple of revenue or EBITDA or price to book, et cetera, as indication of what the market's paying for a similar asset. Another close example is when there's been a recent round of financing or trade in the subject company stock itself. If it's recent and an arm's length negotiated transaction between unrelated parties, then that's going to be a very strong indication of value. On the first 2, the comparability issue is always the question. We get asked to value sometimes unique niche businesses that large actively traded guideline public companies really don't present a similar growth or risk profile. It brings into a lot of subjectiveness as to whether or not the multiples that they're trading at are a reliable indication for where your subject company would be traded. So valuation in all three of these approaches usually involves a lot of subjective judgment and experience, but guidance and best practices suggest that we utilize as many methodologies as possible to try and triangulate on value. And when an indication or approach suggests something radically different from the other approaches or indications, then obviously makes you scratch your head and question your inputs. The income approach, getting to specifics, is a discounted cash flow methodology, where we're looking at forecasted cash flows and discounting them at an appropriate required rate of return. Obviously, the issue there is whether or not a forecast exists or whether or not it's reasonable. The difficulty gets into when we're dealing with the VC early stage companies that either don't have current profits or revenue and really have no insight into the forecast. Our job as valuation practitioners really isn't to forecast the company's outlook. It's to take management's forecast and apply our math and our judgments on required rates of return to determine fair value. So we rely typically very heavily on management for that forecast, and management being defined as either subject company's actual management or funds, deal teams themselves that might have better insight as to the operations of the company than we would. Capitalization of earnings approach, simply where you don't have a forecast, but you've got a generally stable business where you're going to say, hey, I'm going to look at the average last 3 or 5 years or last year as a normalized level of earnings, and I'm going to capitalize it into perpetuity. The cost approach is really a replacement type of concept where an investor would not pay more for something that they could easily duplicate through an investment of their own. You see this a lot in asset-intensive companies. You see it in valuation of certain intangible assets like technology. The typical situation is, let's say you've got a software platform that is hard to value from an income perspective, but if you can get an estimate of time it took to code and develop at an hourly rate, that's your best estimate. Typically, usually not utilized in the valuation of a private equity or debt investment, obviously, except where, again, we're bringing in original investment or investment at original transaction as kind of a concept. Next slide, please, Marley. In general, in your valuation policies, procedures, and in the valuation process itself, you should really consider kind of the sources of the prices and the inputs and where they're coming from. Are they reliable? If you're talking about level 1 securities or level 2 securities, are you getting it from reputable broker dealers? Are they consistently being produced? If you're using a pricing agent, understanding how that pricing agent is deriving their prices. Are they auditable? Are they corroborated by another pricing service, et cetera? Methodologies and valuations should also consider the priority of those sources. Again, I think it's pretty obvious if you're going from level 1 to level 2 to level 3, the priority would be in just that order. The most liquid, observable input is always the best. And I should kind of revisit that ASC 820 in general emphasizes the use of observable inputs as much as possible over those that are unobservable. Talk about valuation methodologies and to what assets they're usually applied. Again, when we're valuing private equity investments, it's typically a combination mostly of the income and market approaches. We will use cost again as an indication if it's been in a recent transaction. Structured products, CLOs, MBS, things like that. Loan pools, consumer loan pools. Usually an income approach where we're looking at expected payments principal and interest or what have you. But we're looking at trying to identify key drivers of what's going to impact those cash flows, such as default rates, recovery rates, in addition to trying to specify required rates of return. Particularly difficult when you're getting into collateralized securities where you've got different tranches of priority and seniority that may have different default rates and recovery rates at each tranche. When we talk about preferred equities, convertible preferred, convertible debt for that instance, you're usually talking about optionality of the security. Preferred obviously usually has a liquidation preference and a preferred payment. That's easy, straightforward to value it using an income approach, discounted cash flow analysis. But when you have attached warrants or options, those need to be bifurcated and valued separately, which obviously requires valuation of the underlying company itself. When we value convertible debt, for instance, debt that's issued with an option or a warrant, we'll look at the yield that at issuance as generally being an indication of fair yield. But what we'll typically do is back out the value of the warrants or the options and then recalculate what the pure bond value is and recalibrate the stated yield as a benchmark for going forward. Fixed income securities are basically that then. They're based on a spread-based model. We establish what the yield was at issuance, whether or not it's stated or readjusted as I just described. If it's a floating rate note, we will usually just assume that it'll be tied to the same LIBOR or whatever going forward. Fixed rate notes, though, are usually based on a spread. So we will take the implied yield or the stated yield, extrapolate what that means over a treasury security of a similar maturity, establish an option adjusted spread, and then we will look at how the treasury markets and frankly how the credit markets move over time to recalculate what we believe the fair market yield should be on the bond going forward. But again, debt securities are typically an income approach. You're going to understand or have an expectation of future principal payments and interest, whether it's PIK or cash, and they're just discounted at present value over the life of the bond. Last thing I would just indicate for consideration of valuation firms. Obviously, independence is a key thing. Expertise in asset class and industry is also very important. The methodologies are the same depending on, regardless of industry, regardless of geographical location, et cetera. But having expertise in a particular industry, geographical location is obviously better than not. Experience in dealing with auditors, regulators, and even administrators is very important as well. Firms like ours are often asked to present to boards of directors or investor groups, and we're happy to do so. Having the competence and skill set to understand what their key touch points are and to be able to help them understand the process is important. Auditor interaction is obviously a key thing as well. Auditors, particularly over the last 5-6 years, gotten very particular on the things that they like to see, and having experience with the range of auditors and understanding what their expectations are, being able to build that into your valuation models and your valuation reports to scratch their itches is obviously very important. Obviously, capacity and resources are important as well, and then the access to the market information that is required. Firms like ours, and we're not unique, have special databases that we have access to. A lot of our fund clients have the same databases, so it's nice to be able to pull similar information from similar sources so that you're on the same page starting forward. Smaller firms tend necessarily not to make the investment in those resources, such as Capital IQ, Bloomberg, GF Data, other market-based analyses. So just in general, independence is key. Experience, both in the industry and dealing with the interested parties, are kind of the key things to consider. With that, I think it's time for poll question number 2.
We'll pass it on to Christine with Richey May now.
Thank you, Paul and Monica. We're going to start this section with a poll question. What is your role in the alternative investment space? Is it an investment manager, third-party administrator, auditor, or other?
Give you just a few more seconds to get your answer in. Looks like a majority of us on here are investment managers and administrators.
Thank you, Gabriella.
There you go.
Paul provided us insights to approaching valuation, as well as describing the inputs considered when valuing investments. I will discuss valuation from an auditor's perspective and the U.S. GAAP disclosure requirements. One of the key items that auditors consider when auditing alternative investment funds is the value of investments held at the reporting date. Pursuant to FASB ASC 946, an investment company shall measure investments in debt and equity securities subsequently at fair value. FASB Topic ASC 820 establishes a framework for measuring fair value and requires disclosures about fair value measurement. According to FASB Topic ASC 820, fair value should be estimated using the assumptions that market participants would use in pricing the asset or liability, assuming the market participants act in their best economic interest. Fair value is defined in ASC 820 as the price that would be received to sell an asset or paid to transfer a liability in an orderly transaction between market participants at the measurement date. Your auditor will consider the overall risk of misstatement and the overall effect that a misstatement may have on the fund's investment balance. The auditor will then develop an audit approach related to the valuation of your fund's investments. Your auditor will request various information in order to audit the valuation of investments. It is considered best practice for the general partner to be able to provide a valuation policy for each type of investment. Paul outlined various aspects related to the valuation of investments. Please consider these items when developing or reviewing your fund's valuation policy. Level 1 inputs consist of unadjusted quoted price in active markets for identical assets or liabilities. Quoted prices should not be adjusted because of the size of the position relative to trading volume. For example, a blockage discount. Bid quotes are preferred for long positions given the exit price concept. Funds often have investments such as public equities whose value are readily available through valuation services or on the internet. These investments are considered to be level 1 investments. The auditor will request additional information related to investments that fall into level 2 and level 3 or are valued using the practical expedient. It is best practice to provide your auditor with evaluation write-ups and underlying support that the general partner prepares and utilizes as part of the investment monitoring process. Level 2 inputs are inputs other than quoted prices included within the level 1 hierarchy that are observable for the asset or liability, either directly or indirectly. For example, quoted prices in inactive or similar markets. Broker quotes can be used if the trade can be executed at that price, though more than one or two broker quotes is preferred. Level 2 investment valuations are supported with observable inputs. Observable inputs are defined by the FASB as inputs that are developed using market data, such as publicly available information about actual events or transactions, and that reflect the assumptions that market participants would use when pricing the asset or liability. Consideration should be given to the observable and non-observable components of investment valuation when making the determination of whether the investment's value is considered level 2 or level 3 for US GAAP purposes. The more weight observable inputs provide, the more likely the investment valuation will be considered level 2. Unobservable inputs are defined by the FASB as inputs for which market data are not available and that are developed using the best information available about the assumption that market participants would use when pricing the asset or liability. A level 2 investment's value may be valued through valuation services like level 1 securities. For example, certain cryptocurrencies can be valued using a specialized valuation service. Since cryptocurrencies trade on multiple exchanges, the opportunity for arbitrage exists. Therefore, cryptocurrencies may be considered to be level 2 investments from a US GAAP perspective, even if a quote from a pricing service is available. Certain investments whose values are derived with observable inputs that utilize a valuation model are also considered to be level 2 investments. Level 3 investments are investments whose valuation is derived primarily with non-observable inputs. The auditor will request individual investment write-ups and underlying support in order to gain an understanding of the investment's fair value. Examples of underlying support include capitalization tables, recent rounds of financing, and other legal documents and reports from valuation specialists. This list is not all-inclusive. When applying audit procedures to the valuation of level 3 investments, the auditors will consider the applicable audit guidance, such as the guidance provided in the AICPA, Private Equity, and Venture Capital Accounting and Valuation Guide. The auditor will perform audit procedures to complete the audit process related to the fair value of investments. Auditors utilize audit techniques such as confirmation, recomputing, analyzing investment valuations methods, documents such as partnership and purchase sales agreement, industry and publicly available information, and the general partners, analysts, and support. The Fair Value Best Practice and Implementation White Paper that Houlihan and Richey May co-authored in September of this year provides a decision tree for direct and co-investments that can assist general partners in determining the best valuation method to utilize based on the type of investments and the investment life cycle. When investments do not have a readily determinable fair value, and the investment is an investment company within the scope of FASB Accounting Standards Codification Topic 946, investment companies, or an investment real estate fund, fair value is measured using net asset value per share or its equivalent. The fund is permitted to measure fair value using the net asset value per share as a practical expedient. Certain factors, such as the measurement date of the investment versus the reporting entity and management's commitment to sell the investment, need to be considered as described in ASC Topic 820 related to the use of or adjustments to the practical expedient as the fair value. It is now time for the next polling question. What level in the fair value hierarchy are the majority of your investments? Please select one.
We'll give you a few more seconds to get your answers in. It looks like the majority of you are using level 3, followed by level 1.
I will now talk about the U.S. GAAP disclosure requirements under ASC Topic 820. In August of 2018, ASU 2018-13 was published. The purpose of this ASU was to change the disclosure framework requirements for fair value measurement. Prior to the adoption of ASU 2018-13, the FASB required the following items to be disclosed for non-public funds. An accounting policy footnote regarding the fair value measurement policy of the reporting entity. When developing this accounting policy footnote, general partners should consider what types of investments the fund holds and how the investment values fall into the fair value hierarchy. Tabular presentation of the fair value hierarchy of investments at the reporting date classified in the fair value hierarchy and practical expedient if applicable. The total value of investments should agree to the value reported on the face of the financial statement. If a fund does not hold any investments valued using the practical expedient, reference to the practical expedient may be removed from the disclosure. In addition, if all of the investments fall in one level of the fair value hierarchy or the practical expedient is used, a sentence stating this fact may be used in lieu of the table. Another item is a tabular representation of the roll forward of the level 3 fair value measurement as of the reporting date, including the unrealized appreciation or depreciation included in earnings during the reporting period. Subcomponents including in this roll forward include the beginning value of level 3 investments in the prior year financial statements, purchases and sales of investments, changes in the investment cost due to paid in kind interest, realized and unrealized gains and losses, and transfers in and out of level 3. The ending result should agree with the fair value of level 3 investments at the reporting date. Just moving on to the next slide. If applicable, the amounts and reasons for transfers between the levels should also be reported. Prior to the adoption of 2018-13, a policy of timing of the transfers between the level was required. Unrealized appreciation or depreciation related to level 3 investments still had on the reporting date is another item. The final item was a tabular presentation of the quantitative information regarding the significant unobservable inputs for level 3 investments, such as the valuation method and relevant multiples. After the adoption of ASU 2018-13, some of the items that I had previously discussed are still required from a disclosure point of view, but there are some changes. After adopting ASU 2018-13, a tabular presentation of the level 3 fair value roll forward as of the reporting date is no longer required. In lieu of a tabular presentation of level 3 fair value roll forward as of the reporting date, a non-public entity is required to disclose transfers in and out of level 3 of the fair value hierarchy and the purchases and issues of level 3 assets and liabilities. For certain investments that calculate net asset value, an entity is required to disclose the timing of liquidation of the reporting entity's assets and the date when restrictions from the redemption might lapse, only if the reporting entity has communicated the timing to the entity or announced the timing publicly. ASU 2018-13 also clarifies that the measurement uncertainty disclosure is to communicate information about uncertainty in the measurement as of the reporting date. Many of our clients had early adopted ASU 2018-13 during the prior to year ends, but for those entities that have not adopted this ASU, they will be required to, for fiscal years and interim periods within those fiscal years beginning after December 15, 2019. This concludes our formal presentation. I hope you enjoyed it. We will now respond to questions that we have received from the participants. Gabriella has just provided me a few of the questions that you had sent over to us. I will go through a few of them. One of our questions is, one of the participants would like to know, their fund is closed to new investors. To my understanding, they must be a private equity or venture capital fund. They want to understand if they can value their investments in a conservative manner, or keep the investments valued at cost, even though there's some evidence of the valuation change. FASB topic ASC 820 defines fair value as the price that would be received to sell an asset or pay to transfer a liability in an orderly transaction between market participants at the measurement date. If the fair value is materially different than the conservative value, the fair value of investments, carried interest allocation, and possibly the management fee could be misstated. So it is important to consider changes of the value that would change the results of the financial presentation. If an investment provides me with a capital account, am I required to use this value? Is another question. When determining if an investment can be valued in the practical expedient, certain factors such as the measurement date of the investment versus the reporting entity, management commitment to sell the investment, or other factors discovered through the investment monitoring process should be considered. So therefore, fair value for a practical expedient investment may be determined to be different than the practical expedient, and therefore the investment would be most likely considered to be level 3. Paul, there's a question that we have received for you. How do you account for public company comparables being orders of magnitude larger than the target company? This is one of the questions that we've received.
Yeah, thank you. It's a difficult area for us. When we think about where companies would trade or where a subject company is worth, trying to make comparisons to larger publicly traded companies, we really think about 3 things: relative growth, relative profitability, and relative risk. Clearly, the larger the company, the lower the risk profile. There are mathematical ways that we can make adjustments by looking at, say, for instance, and I don't want to get too technical, but if you made a $1 investment in your subject company at its required rate of return and its growth profile, what would be the present value of that $1? And do the same for the large comparable company, which has a different growth profile and a different risk profile. You'll get 2 different present values, and if you take the ratio of those, it'll give you some judgment as to how to adjust the multiples. Again, it's a mathematical exercise. Ultimately, it just comes down to a lot of judgment. It's very interesting. Again, when we look at subject companies that are smaller, maybe niche, maybe more product focused, the larger guideline public companies don't often lend themselves to being comparable. Yet if they all trade in a tight range and using your pure judgment and experience as to where a smaller company would trade versus them, that will help. Again, in large part, there's some math that can be done, but it's a lot of judgment. There's another question here, Christine, that I'll answer as well, and that is other sources of private equity multiples. So one of the things that we do like to do, again, when looking at the market approach, is not only look at where the public companies are trading, but also look at where comparable transactions have occurred. The data isn't great. It's not delineated very clearly, but there is a database called, or a firm called GF Data that compiles via self-reported transactions from private equity firms as to what multiples they paid via NAISC code. The data is usually lumped into sizes of EBITDA range, 5 to 10 million, 10 to 20 million, et cetera. And it will be sorted by year, not necessarily period or month, but it is often related to companies that tend to be smaller than the very large public companies, and tends to provide us with very good insight as to what kind of those adjustments or relative levels of market multiples should apply to a smaller niche-focused company rather than the public. So the answer to both questions is there's judgment. There is data out there from the GF database that helps us, but this market or this approach to valuation is probably the most subjective one there is.
Thank you, Paul. I'm just looking through some other questions that are coming in. I'm not sure if you covered that in your prior discussion, Paul, but one of the questions says, since P funds are not paid on committed capital and exit, not subject to valuation, what are the areas that trip up PE funds most often?
Yeah, it's a good question, and we get it a lot from certain private equity funds. Obviously, the hedge funds and others that charge AUM, and the mutual funds, 40 Act funds that have daily buy-ins and redemptions. Fair value is quote unquote more important, but the private equity funds that we work have found that it is a best practice, if not a requirement, by their LPs to have someone either independently valuing their portfolio or testing their portfolio or a portion of the portfolio, or something else that we do, and that is validation, where we are reviewing their internal valuation memos and write-ups and providing them guidance and opining as to whether or not they're reasonable. I think the direct answer to your question is where do private equity funds get tripped up the most is when they're out fundraising for the next fund. And if they are basing market performance metrics based on their historical fair value estimates, which were done internally, it can bring possible conflict of interest, if not questions from the new fund investors and or the SEC if it's a registered fund. So yeah, there's not a direct compensation issue to it, but it typically gets tripped up when they are out marketing, or frankly at exit when the fund is being liquidated at values that are materially different from what's been self-reported internally.
One of the participants is looking for our white paper. We can send the white paper out to the participants when we send the slides out, so that you'll have that as well. Paul, one of the questions is asking, what are the best practices surrounding valuation of early repayment fees, make-whole fees on debt instruments, the stated fee amount at the different repayment dates?
Yeah, it's a good question. It's a complicated answer as well. On fixed income securities in particular, whether or not it's just a straight single loan or, again, a loan portfolio, you're looking at expectations. Sometimes there isn't a clearly defined binary answer to things. Early payment fees, it's really usually based on a probability-based estimate, where we will take fund management.
One of the participants is asking, are there individual investment write-ups required? It is best practice to have a written valuation policy and to document the monitoring and valuation of each of your investments in your portfolio. As Paul described earlier, Houlihan does provide valuation services that could be completed independently, but many smaller investment companies do perform their valuation in-house as well.
Check to make sure no other questions have come through real quick.
One of the questions is it permissible for a PE fund investing in a small, relatively unsophisticated companies to have a valuation policy that allows for holding investments at cost for the first year, while the investment company incurs expenses to build out its infrastructure that would depress EBITDA temporarily, as well as getting its fund reporting cleaned up? I will take a stab at answering that one, but then I'll hand it over to Paul. From a U.S. GAAP perspective, under ASC 820, you should have a valuation policy that would lead you to the correct fair value of the investments. Although it is, in certain early stage investments, it is common to see the investment still held at cost. And I'll refer you to our white paper as well that talks about the decision tree in valuing investments. Paul, did you have anything else to add? I think we may have run into technical difficulties, but we did receive a few other questions as well. We will, for those questions that we didn't get to today, we will be responding to by email directly to that participant. I'm just going to hand it over to Gabby for our final housekeeping items.
Thank you, Paul and Christine, for this webinar presentation today. I know many of us found it very helpful, so we appreciate you taking the time to put this on. Like Christine mentioned, if we didn't answer your question that you submitted, we will reach out to you directly following the webinar. A recording of today's webinar, along with the slide deck, will be emailed to all registrants following this webinar. You will receive that to your email either later today or tomorrow. And if you have a minute to fill out the survey, it will appear on your screen at the close of today's webinar. We would really appreciate it if you could fill it out for us so that we can continue to improve these webinars and make them as valuable to you as we can. So again, thank you so much for joining us. We hope to see you on our future webinars.
Thank you.